Good evening.
Good
Good
evening, sir.
evening,
Good evening,
sir.
sir.
Good
Good
evening,
Good
evening.
evening.
everyone. How are you all?
Awesome, sir.
Great,
Fine, sir.
superb. Yes, all of you quickly. Cameras on. Yes, everyone. Quick, quick, quick. Switch on the cameras and let's start. Yes, financial management, the efficient procurement of funds and effective utilization of funds. Yes. So, first of all, I hope you all have got the revision materials with you.
Yes,
Yes
sir.
or no? Yes.
Yes,
All
sir.
right.
Yes, sir.
And a revision material, I'll go through the structure and everything. Okay. And we will go through the import whatever chapters we have done. That is obviously there. We'll go through one suggested answer just to understand what the question paper pattern looks like. Okay. There is one section which has all the formulas put in one place. So from today, you need to take a note that every day 5 minutes you'll go through those formulas. Every day. 5 minutes you just go through that formulas, so you'll become perfect with all the formulas. Okay, all of you. I know there are a lot of formulas in FM. So FM is based out of formulas itself. So every day just spend 5 minutes. In the start you'll spend more time, but trust me, in the end, in 2 minutes you'll be able to revise all the formulas if you do it on a daily basis. Okay, I want to start off with this. Okay, now. Yes, so financial management. So, unlike your accounts, which is reporting the decisions taken, financial management helps you to take those decisions, right? So, financial management has two aspects, one is procurement of funds and then utilization of funds, right? So, how you procure your sourcing of funds, which are the sources of finance, that is your chapter 2 which you will be learning, right? So normally theory I'll do it at the end. Okay, normally theory I do it at the end, so you'll be learning all the different types of finances, but even otherwise you all know the different source of finance. You have been learning from your PUC days, right? Preference shares, debentures, what are the different types of preferentials? You have convertible, non-convertible, redeemable, irredeemable. Yes or no? Then debentures also, preference shares also similarly. Correct or not? With the different rights they have. Clear, all of you? Preferred, preferential rights, etc. Yes, so all of the different source of equity. Then you have your debt, right? Different source of debt, your bonds, debentures, your loans, term loans, short term, long term source of finance. Yes, so all of these are your different sources of finance. That is from where you procure. Now, how much to procure, in what quantity to procure, right? That, and in what proportion to procure, that you learn in your capital structure chapter. Yes or no? In capital structure. And what is the cost of the capital? For that, we have one dedicated chapter called as cost of capital. Clear, all of you? Yes. All right. And then we learned leverages, right? Leverage chapter, which is basically telling you what is the influence or power of one financial variable over another financial variable. So these aspects we have already discussed and learned, and we also started learning about dividends. Correct? Dividends, anyway, most of the theory topics we have already covered in the last class itself. Okay, so we'll focus and try to complete very quickly capital structure, then leverages and cost of capital. Clear, all of you? Yes. All right, open your revision materials. Yes. So look at this now. So high scoring areas, right? Problems only. Leverage and dividends. I always say this. Always start with leverages and dividends because they are very sweet, simple chapters. But you have, almost like 10 marks coming from these chapters alone. Okay. And normally question one, your initial questions only will have leverage and dividends. Then cost of capital, easy, weighted average cost of capital problems come. Ratio analysis, which we will be learning, balance sheet construction, etc. Then capital structure, choosing the best financial alternative. After that, you have your investment decisions and working capital management, which you'll understand later, right? And theory chapters. Okay, so these are your important ones. In that ratio analysis only, practice all unique type of problems, right? Identifying the starting point. So all of these are there. So when I do ratio analysis, I'll focus more on this point: working capital management, investment decisions. Yes. So reading time allotted only 15 minutes. I think all this is. You can go through this. How do you approach? For now, you can go through. I'll be covering it up more in your R2C sessions. Yes, so go through all the formulae daily for 10 to 15 minutes. Understand the formula with reasoning. It becomes easier to recall. Okay. Then your past trend analysis is given. You can check here from December 21 onwards, each examination. What is the which question number, what topic it has come? Can you all see this? Yes. Which question number, what topic? So introduction chapter, if you see here, right? Question 6C, question 6C, right? 6C, 4A ಅಲ್ಲಿ ಟ್ರೂ ಆರ್ ಫಾಲ್ಸ್ ಎಟ್ ಕಮ್ ದೆನ್ 4A 4C ಅದು 4 ಏನಕ್ಕಾಯ್ತು ಬಿಕಾಸ್ ಸಿಲೆಬಸ್ ಚೇಂಜ್ಡ್. ಈಗ ಕ್ವಶನ್ 4 ಅರ್ಥ ಆಗ್ತಿದೆ ನಿಮಗೆ. ಸಿಲೆಬಸ್ ಚೇಂಜ್ ಆದ ನಂತರ ಈಗ ಕ್ವಶನ್ ಪೇಪರ್ ಪ್ಯಾಟರ್ನ್ ಚೇಂಜ್ ಆಗಿದೆ. ವಿಲ್ ಬಿ ಸೀಯಿಂಗ್ ದ ಕ್ವಶನ್ ಪೇಪರ್ ಪ್ಯಾಟರ್ನ್ ವೆರ್ ಯು ಹ್ಯಾವ್ ಓನ್ಲಿ 4 ಕ್ವಶನ್ಸ್ ಇನ್ ಯೋರ್ ಡಿಸ್ಕ್ರಿಪ್ಟಿವ್. ಅದಕ್ಕೆ ಕ್ವಶನ್ 4. ಸೊ ಲಾಸ್ಟ್ ಕ್ವಶನ್ ಅಲ್ಲಿ ಯು ಕ್ಯಾನ್ ಸಿ ವೆರಿ ಕನ್ಸಿಸ್ಟೆಂಟ್ಲಿ ಕ್ವಶನ್ ನಂಬರ್ ಇಂಟ್ರೊಡಕ್ಷನ್ ಚಾಪ್ಟರ್ ಇಂದ ಕಂಪಲ್ಸರಿ ದೆರ್ ಆರ್ questions. So on an average 3 to 4 marks is being asked from this chapter. So if you see the recent trends, on 4 mark question onto coming from introduction chapter. Same way you have types of financing, then ratio analysis. All of these you can just check the trend. Artha agta idya all of you?
Yes, sir.
Yes. And the marks. So if you see question 1B, then 1A, this was asked in your MCQ question was there. Then 3B, like that. And what topic, right? Which ratios were asked, that is also given. So you can go through this. It gives you a very reasonable understanding of your past trend. Clear all of you? Sir, should we focus only on this? No, it gives you the areas that are more frequently asked, therefore you cannot skip it or you cannot miss it or you cannot keep it for the end. These are the areas to be covered first. Artha agta idea? Right? But sir, if I do only this and go, definitely it's not going to help, because the question paper will be designed in such a way that there will be some of the repeated areas, but there will be some unique areas coming. ಅರ್ಥ ಆಗ್ತಿದೆ ನಿಮಗೆ? That is how a professional exam will be designed, right? So what you have to do, you need to go through the repeated areas so that you can focus on those first. But equal importance should be given to the later areas also. Why you should focus on this first? So that even by mistake you don't miss these topics. Clear all of you? Yes. All right. So if you see the marks almost on an average, first chapter, second chapter, can you see? Right? 3 marks. 3 andre actually ಈಗ 4. Now if you ask me, it is 4 in the recent past. ಅದು because number of attempts little more, 3 ಆಗ್ತಿಲ್ಲ 4. This is also around 4 chapter. First chapter and second chapter in the normally questions are being asked. Clear all of you? 1 4 mark question is coming. Then ratio analysis almost 5 to 6 marks, right? Then your ಇಲ್ಲಿಂದ I think cost of capital, right? So cost of capital, you can see here is cost of capital around 8 marks, on an average 8 marks. Can you see? Yes. Then capital structure again around 8 marks. Capital structure. Leverage, can you see this? 6 to 7 marks. Recent past here 9 marks was asked from leverage. Can you see this? May 25 examination 9 marks from leverage. Okay, here 5 marks, here 7 marks. So average 6 to 7 marks. Investment decision, right? Huge chapter, but normally around 8 marks is coming in each of the examination. Dividend decisions, very small sweet chapter, again on an average 4 marks. On an average 4 marks is coming from dividend decisions. Then working capital management, again 9 to 10 marks, around 9 marks is coming from working capital management. Clear all of you? Yes. So Aditya, I hope this is clear. Then you have your all the formulas I told you in one place. You have put in all the formulas that is there, right? If there are 1 or 2 additional formulas that you come across, you can add it up here. Clear? Yes. All right. So this is what I said. 2 basic aspects of financial management: effective procurement of funds and efficient utilization of funds. Illiga, we cannot create an asset without creating the liability. Illi, very important. There are three important decisions of a finance manager: investing, financing, and
Dividend.
dividend decisions. What is what is your financing decision? Yes. What is the financing decision?
Choosing the source of capital.
Choosing the correct source of capital. Yes or no? That is your financing decision. That is one source. Second is what? Quantum. How much of capital I should procure. Third is at what cost of capital I should procure. All of these are your financing decision. Then your leverage. Should you go for more debt? Should you go for equity? What will decide ROI is greater than I or not? ಅರ್ಥ ಆಗ್ತಿದೆ ನಿಮಗೆ? Yes. If ROI is greater than I, then what is preferred?
Debt.
Yes, if ROI is greater than I, then debt is preferred. Why debt is preferred? Because your interest cost can be easily covered. Is it clear, all of you? Yes. All right. Okay. Again, there's a mistake. Very time. Then correct money, please. Please correct this mistake. Efficient procurement of funds, effective utilization of funds. Always efficiency is related to your quantity aspect. Remember your employee cost. ಯಾವಾಗಲೂ ಅದನ್ನೇ connection ಕೊಡೋದು. Yes, when you call an employee as efficient, if he has done the product in 3 hours, right? An employee has done it in 3 hours. Another employee has done it in 0.5 hours. You call the 0.5 hour as efficient, correct or not? Efficient procurement of funds and effective utilization of funds. Please, are the correct ಮಾಡಿ. Yeah. Always, remember this, right? If you ಹೆಂಗ್ ನೆನ್ಪಿಟ್ಕೋಬೇಕು, I remember that example, right? One is quantity aspect, one is quality aspect, one is halse, one is row one. ನೆನ್ಪಿದೆ example? Yes or no? So a person would have put 0.5 hours. He is efficient. Is he effective? That's the question. Is he effective though? Is he following the quality norms? He may not be. Clear, all of you? That is the difference between efficiency and effectiveness. So efficient procurement of funds, effective utilization of funds. All right. Yes. So three important decisions: financing, investing, and dividend decisions. All right. So with respect to your introduction chapter, the two major objectives, right? The primary objective, the long-term objective of financial management is always wealth maximization, wealth maximization, and wealth maximization. Is it clear?
Yes,
This is
sir.
always wealth maximization. The short-term objective is only profit maximization. It's only a means for achieving your main objective, that is wealth maximization. Understood?
Yes,
All right.
sir.
So with that, let us start with the first chapter, that is cost of capital. The cost of providing capital, right, is nothing but your cost of capital. The expectation of the stakeholders or the expectation of the providers of capital is the cost of capital. Clear, all of you? Yes. All right. So the significance of cost of capital, evaluation of investment options, it helps in financing decision, that is with choosing the source of finance, and then for designing optimum credit policy. There are three significance of cost of capital. It's also called cutoff rate or hurdle rate. Cutoff rate or hurdle rate. Why? Because that is the minimum cost of capital or the minimum required rate of return. Therefore, it is also called as hurdle rate or cutoff rate. Clear, all of you? Yes. Then you have your different formulas, right? So first is your cost of debt, KD. If it is irredeemable debt, the formula is very simple. KD is equals to I into 1 minus T by net proceeds. If it is redeemable debt, KD is equals to I into 1 minus T plus RV minus NP by N. This N should come below this. Okay, whole divided by RV plus NP by 2. This is called approximation method, right? So net proceeds is issue price minus flotation cost, I is interest, and T is tax rate. RV redemption value, N is maturity period, irredeemable preference capital, KP is PD by NP, that is P naught. Here PD is the preference dividend. Clear, all of you? Redeemable preference capital, KP is equals to PD plus RV minus NP by N, the whole divided by RV plus NP by 2. The only difference between preference shares and your debt is what? It is tax deductible. Interest is tax deductible, Likita. Preference shares, preference dividend is not tax deductible. Clear, all of you? Next, most important thing. N is always N is always the balance maturity period. That means P naught is always your current market price. If the issue is happening today, Smita, only then it is issue price. If the issue is happening today, only then you will consider issue price. Otherwise, you always consider current market price because you want the cost of capital as on today, not as of the past. Is it clear? Right? So you will consider cost of capital as on today. So for that, P naught is considered as on today, and yes, N is your balance life. Cost of equity, there are different approaches. First one is dividend approach. Here, dividend is considered, right? It is considered assumed to be constant. There is no growth. Therefore, assumption is 100% dividend payout. Understood? Assumption is 100% dividend payout. Therefore there is no growth. You remember, growth is there when there is retained earnings, because again the assumption is the only source of finance is retained earnings. Clear, all of you? The assumption is that the only source of finance is retained earnings. Therefore, when there is no retained earnings, the assumption is that there is no growth, and therefore dividend is assumed to be constant. Formula is what here? KE is equals to D1 by P naught. KE is equals to D1 by P naught. Clear, all of you? That is my dividend approach. Next comes earnings approach. Under earnings approach, earnings is considered instead of dividend. Actually, technically, E and D should be same in this case. Why? Because dividend is 100% payout. Dividend payout ratio is 100%. So therefore, technically, D and E in this case should be same. However, there are two different approaches. Here you take earnings. Is it clear? Therefore, earnings by P naught is KE. There is no growth here also. Under both the approaches, the assumption is that the market price will move in proportionately and will grow in the same rate as that of the, not grow, sorry, there is no growth, that the dividend and your market price are both correlated. Understood, all of you? That the both are correlated. So the only expectation is dividend and earnings in the individual cases. The only expectation under dividend price approach is dividend, and earnings is earnings, but technically both are same because 100% dividend payout is the assumption here, and therefore there's no growth. Next one is your growth model, right? That is Gordon's growth model, GGM model. Yes, under Gordon's growth model, the formula is very simple. K is equals to D1 by, again, net proceeds. It is always P naught. Whenever I say P naught, it is net proceeds. Clear, all of you? You should always subtract flotation cost. Flotation cost is calculated on what price? On the face value or issue price or current market price. It is normally always calculated on the issue price until and unless there are some questions where they have specifically given to calculate on face value or the issue or the market price. Understood? Otherwise, it's always on the issue price. The price at which you're transacting, that is what has to be considered. Clear? For flotation cost. Therefore, flotation cost has to be subtracted and then net proceeds has to be calculated. So again, the formula is D1 by P naught. D1 by P naught plus G. D1 by P naught plus G is the Gordon's growth model. Here, under Gordon's growth model, G is equals to B into R, that is retention rate into rate of earning. Retention rate into rate of earning. The rate of earning is nothing but ROE, return on equity. Is it clear, all of you? Right? That is my Gordon's growth model. Then you have got residual approach. As a realized yield approach, your realized yield approach is based on the past trend, right? Historical data when you calculate, that is my realized yield approach. Here normally there will be a capital gain. Otherwise, we don't consider capital gain, right? Here capital gain is also considered. Understood? Therefore, P1 minus P naught is considered plus D1 is considered. If it is say for one period, if it is say it is for one period, then P1 minus P naught plus D1 by P naught will give you your realized yield approach. So obviously you need to discount it, divided by 1 plus, it has to be discounted, and then that you equate it with P naught. Understood? Right? It has to be discounted at KE, and that has to be equated to P naught. Is it clear, all of you? This is my realized yield approach. Next comes your last approach, that is capital asset pricing model, CAPM. CAPM formula is very simple. K is equals to RF plus risk-free rate of return plus, right? You're taking risk, therefore you should get something premium. Therefore, market risk premium for investing in market portfolio. But if you're investing in a particular company, then it will have more risk than the market, therefore more or less risk, right? It could be either more or less risk. You have to multiply that with beta, which calculates the systematic risk of that particular stock with comparison to the market. Understood? systematic risk only. Therefore, formula is KE is equals to RF plus RM minus RF into beta. Is it clear, all of you? Yes. So these are your cost of capital formulas for equity. Right? So K is equals to D1 by P naught. D1 is expected dividend at the end of first year. Whenever they use the word expected, right, you have to consider future. If they use the word paid, then it is past. Understood? D naught. Alright. Earnings price approach, Gordon's model already discussed. Then another method to calculate the growth rate is the average method. Dn is equals to D naught into 1 plus G to the power n. CAPM approach, all of this already discussed. Only systematic risk is considered. That is my non-diversifiable risk. Difference between systematic risk and unsystematic risk. Systematic risk is non-diversifiable. Unsystematic risk is diversifiable. Clear? Systematic risk is macro, not within your control. Unsystematic risk normally micro and within the control of the organization. It is specific to the particular company. This is in general. Clear, all of you? Yes. Example, recession, war, etc. These are your systematic risk example. Unsystematic risk, sudden strike by employees of the company. All right. Yes, next comes your amortization of bond. Here, you have to consider all the cash flows that are coming from the bond. So now you get interest year on year. You're also getting principal rate repayment year on year. Understood, all of you? Therefore, interest plus principal repayment if it is cash flow of the first year. Therefore, same way for second year, right? C1, C2, C3, C4, you have to all discount it at KE. Understood, all of you? Yes, discount it at KE and that you will get the value of the bond, which is VB. Clear? Next, cost of convertible debentures. Convertible debenture is an option and not a obligation. It is a choice and not an obligation, right? To either convert it into equity shares or take in the form of cash. Clear, all of you? All right. The cost of convertible debentures, yes, the option is now or in future. It's obviously in future. Yes or no? The option is given in the future. In future, they have the right, the option given to them to either convert it into equity or take the redemption. Clear, all of you? Yes. So it will be redeemed normally at face value, right? Not just convertible debentures. All debentures, if the question is silent, all bonds, if the question is silent, we assume that the redemption is at face value. Clear, all of you? Yes. So it will be normally redeemed at face value, right? Or it may be converted into whatever the number of equity shares is that is given. Say into 2 equity shares, 3 equity shares, etc. depending on the conversion ratio given. Understood? So for that, normally equity price as on today would have been given or the current market price would have been given. They would have given you growth rate either directly or indirectly by giving the trend of the market prices. Identify what the growth rate is or maybe redemption rate and rate of return is given. You might use that formula to find out what the growth rate is and then calculate what will be the market price at the end of which year. Say the maturity period is 5 years. Say the maturity period is 5 years. You will find out P what? You'll find out P what? Anybody? P what you will find out? P6. You have to find out P6 because the formula is what? Right? You remember the formula. Right? You have to find out P6. So to find out P6, sorry, you need P5. I'm so sorry. You need P5. So to calculate P5, you will find out D. To calculate P5, you'll find out D6. Understood, all of you? To calculate P5, you'll find out D6. Is it clear?
Yes.
You'll calculate D6 and then you'll use that to calculate what the P5 is. And then once P5 is found out, multiply into the number of equity shares, that will give you the value of the conversion. Clear, all of you? So either that value or your redemption price, whichever is higher, that has to be considered. And then you need to use your approximation method formula, right? That is what? I into 1 minus T plus RV. Your redemption value will be nothing but higher of the above working note. Clear, all of you? That you have to consider. Then minus net proceeds by N divided by RV plus NP by 2. or you have to use the IRR method. What is the IRR method? Under IRR, the assumption is that, right, all under IRR, we assume that the intermediate cash flows are reinvested at IRR, which I'll be explaining in investment decision chapter. But most importantly, what you've learned as of now is that at IRR, NPV equal to what?
0.
At IRR, NPV is 0. Clear? At IRR, NPV is 0. Therefore, present value of cash inflow will be equated with present value of cash outflow. At whatever rate this is equated, that is my internal rate of return. Right? So, therefore, for in debentures and bonds, we also call it as yield to maturity method. Yield to maturity method, wherein you know what the redemption price is, you know what the current investment price is, you know the interest that is received year on year. Use this information and then use interpolation to calculate what my IRR is. Interpolationally, you'll take two limits, right? One lower limit, one higher limit. Is it clear, all of you? You'll take two limits, one lower limit and one higher limit. And from that, you'll calculate what the IRR is. Understood? You'll calculate what IRR is. Now, what is the formula? More than the formula, by common sense, you know how to do it. Remember, all of you, you want NPV to be 0. At the lower rate, NPV is so much. At the higher rate, NPV is so much. Use cross multiplication to find out what the IRR is. But however, for those who want to know the formula is lower rate plus NPVL divided by NPVL minus NPVH into H minus L. We have learned this also. Clear? Yes. So you write that formula, your examiner is happy, maybe you'll get, you will not lose out marks for not writing the formula, but we know that even without writing the formula, we can solve this IRR. Clear, all of you? Yes. So using either IRR method or your approximation method, right, you will identify what your cost of convertible debentures are. Clear, all of you? Yes. All right. Then comes your cost of retained earnings. The cost of the retained earnings is similar to your cost of equity. The only difference is in retained earnings, there's no flotation cost. Clear, all of you? In equity, you normally consider issue price if issue price is known. In retained earnings, there's obviously no issue price because you're not issuing shares. You will rather consider market price. Is it clear, all of you? Yes, this is my cost of retained earnings. And finally, the weighted average cost of capital, the weighted average cost, Mahima, of all the cost sources of capital. Yes, that is right from your preference shares, your debt, preference shares, equity, retained earnings. Right? Respective weight into cost of capital. WD into KD plus WE into KE plus WP into KP plus WR into KR. Multiply and add all of this, you get your weighted average cost of capital. Is it clear, all of you? Then comes your marginal cost of capital. What is marginal cost of capital? The cost of raising additional capital. That marginal cost, what is marginal? Anything additional, extra, that becomes marginal. So here also marginal cost of capital, cost of raising your additional source of finance, that additional finance, that is called marginal cost of capital. Clear, all of you? Yes. So what we have also learnt is, Srisha, if the weights of my existing capital as per the books and the additional capital or the marginal capital is same, also the specific cost of capital does not change, then WMCC will be equal to WACC. Clear, all of you? Yes. So these are the different methods of calculating WACC, WMCC. This is the two different cost of capital. Now, most important, what do the weights have to consider? The weights is either book value weights or market value weights. If you have to prefer, weightage will be given more to always your market value weights. Is it clear, all of you? Because market value is the actual figure. Market value considers everything. Is it clear? Book value will not consider everything. That is first. Second, if you're considering market value weights, then if market price of the equity shares is given, that normally incorporates the effect of the reserves also. Do not add reserves again. Understood? Do not add reserves again. That is one. Second, term loan, normally book value is the market value. Normally book value is the market value for term loans. Debentures, obviously market price value will be given, preferences market value will be given. Is this clear? Right. So these are your important points that you need to consider while calculating the weighted average cost of capital. Right. All right. Let us quickly go through your revision material problem section. Look at the question, all of you. ABC Limited has the following capital structure, which is considered to be optimum as on 31st March 2025. This is the existing capital, this is considered to be optimum. These are the weights of debentures, preferentials, and equity shares. The company share has a market price of 19.67. The next year dividend per share is 50% of the year 2024 EPS. That means that D1 is equals to D0 into 50%. Understood? Sorry, EPS 0 into 50%. Is it clear, all of you? D1. Next year dividend is D1. Right? 50% of year 2024 EPS. That means last year the EPS. Artha aita? Yes. Following is the uniform trend of EPS. So therefore 2.36 though, either the 50% when you take, that will be the next year of that will be the next year dividend. Now, following is the uniform trend of EPS for the preceding 10 years and is expected to continue in future. So if you can see, very obvious, it is growing at what rate? It is growing at what rate? 10%, 0.1% Allah, 10%. Clear, all of you? 0.1 or 10%, don't club the two. The company issued new debentures carrying 16% rate of interest, and the current market price of debenture is 96. The current market price of the debenture is 96. So current market price of debenture is given. Current market price of equity share is also given. Understood, all of you? Yes. All right. Is carrying 16% rate of interest. So 16% rate of interest. Obviously, if the face value is not given, you assume it to be 100. Clear? You assume the face value to be 100. The face value is not specifically given. You assume it to be 100. So 100 to 16%. 16 is the interest rate. Next, tax have they given? Tax rate. Tax rate should be given. If it is not given, I just missed, I think.
Sir,
Should
it's
be,
given, sir. 50%.
Allah, that is the next year dividend. Where is the tax rate given?
Not given, sir.
Tax rate is not given. I think Miss Sahil, please write there tax rate is equal to 50%. You please mention, you only write there tax rate is 50%. Okay. Yes, so 16 into 1 minus 0.5 divided by 96, very simple, KD. Then cost of new preference shares, right? So 11%, all of you look at this, 11% again, face value 100. Now again here, face value is assumed to be rupees 10. Please make a note of this. Face value is assumed to be rupees 10 because the market price is 19.67. Face value assumed to be rupees 10. Face value is assumed to be rupees 10 because market price is 19.67. Other do 11%, 1.1 divided by. Some of the information is missed out here. Please write down the information, okay? One is face value of the preference shares is 10 rupees. Current market price of the preference shares is rupees 9.2. Current market price of the preference shares is rupees 9.2. Okay? Alright. Then D1 by P0. D1 is simple. I told you 50% of 2.36 is D1, correct? That is 1.18. Current market price is given here 19.67. Consider that plus growth rate of 10%. You get your KE. Is it clear? Next. Really, one part of the question is missed out. Okay. I'll share this. Okay, all of you. So just ping me. One of you message me and I will share the part. This part is missed out. My MTP is September 25. One part of the question is missed. ಅದಕ್ಕೆ ಅದು incomplete ಆಗಿ ಬರ್ತಾ ಇದೆ. Okay, next. So this is similar to what I've done in the class. All of you look at this, right? Bank term loan debentures which are redeemable at a premium of 5%, preference share capital redeemable at a premium of 5%. The coupon rate of the debentures is 1.5 times that of the bank term loan. Remember this question, all of you? What I've done in the class? The last question that I did in cost of capital is this question, where interest rate was expressed in terms of the other. We had assumed it to be x, then p diya. Then we did that entire WSCC table, formed that equation and solved for x. Do you remember that problem? Yes or no? You can go back and check your class notes, right? The same problem here. So the coupon rate on debenture is 1.5 times that of bank term loan, right? And whereas the preference dividend rate is 1.5 times of debenture interest rate. So debentures is 1.5 times of that of bank term loan. So bank term loan, if it is x, all of you concentrate now. If bank term loan is x, debenture interest would be 1.5x. Debenture interest would be 1.5x. If debenture interest is 1.5x, the preference dividend rate is 1.5 times of debenture interest. Therefore, it would be 1.5 into 1.5x. Artha agta idea? Did you all understand? Yes. The
Yes,
tenure for the bank term loan, debentures, and preferential capital is 3 years, 5 years, and 7 years respectively. The current book value of the capital structure is as follows. Tax rate of the company applicable is given. Debentures are currently selling at a price of rupees 96, whereas preference shares are currently selling at rupees 102. The equity shares of the company are quoted at 150 per share. The ongoing P ratio of the shares is 6.667 times. So from this P ratio, what we can find out?
KE.
KE by using the formula 1 by K, 1 by P is equals to KE. Clear, all of you? That is under which assumption, which approach? Under which approach can I assume 1 by P is KE? Under which approach? Under which equity approach? I told you that under growth model, this will be wrong formula. Why? Because I cannot do 1 by K in that case. Is it clear, all of you? EPS approach, earnings approach, what is the formula? EPS by P naught. Only if earnings approach is used, then I can go ahead with this equation. Fine. That means the assumption is that there is no growth. Understood, all of you? That there is no growth. Then I can use this formula. Is it clear?
yes, sir.
All right. Right? KO is given. KE you have found out using this, and then KO and KE is given. Then they've given everything in terms of one in terms of the other. ಅರ್ಥ ಆಗ್ತಿದೆ ನಿಮಗೆ? So look at this now. Equity share capital KE is given. Reserves KR, can I assume it to be equal to KE? KR, can I assume it to be equal to KE? Tell me yes or no.
Yes,
Yes, because I told you the only difference is flotation cost and issue price. Since here market price only is given, then you can easily assume KR to be equal to KE. Bank term loan debentures, I told you, can be equated to one in terms of the other. Preference dividend also can be equated one in terms of the other. Is it clear, all of you? Right? So therefore, since KE I know, equity share capital, reserves and surplus, overall cost of capital I know, bank term loan debentures and preference capital, all I can express one in terms of the other. Right? And then solve for x. That's the problem. Look at this. Bank interest rate I told you is x. Here it is 1.5x. 1.5 times of 1.5x, that is 2.25x. Is it clear? The same thing is used, and they have found out what the respective cost of capital. Yes. Yes. This problem all of you solve, no? Jan 25 MTP2. go through this problem. If you have any doubts, you can ask me in the next class. Again, this problem, I want you to solve this one. MTP1, September 24, 2024 case scenario. Go through this problem. Yes. KBL has completed 35 years of operations in India. It has many subsidiaries and associate companies in more than 100 countries, right? So it has got business includes a lot of divisions. They're given all of that. Okay. Largest then diverse portfolio. It has a diversified portfolio. The consideration amount will be 1.5 of its average market capitalization. Okay. So the consideration amount will be 1.5x of its average market capitalization. What is market capitalization formula? Market price into number of shares. Is it clear? Market price into number of shares to 1.5 times is its average. It will be the consideration amount. For what to it is planning to acquire one of its competitors named Prestige Limited, which would enhance the growth of KBL. Understood? So the consideration for acquiring KBL is 1.5 times of its market capitalization, has 1,30,000 equity shares, and its shares are traded at an average market price of 45. Therefore, 1,30,000 into 45, either to 1.5 times will be the consideration. Right? And then the consideration amount will be paid equally in 5 years, where the first installment is to be paid immediately. That means first payout is T0. Understood, all of you? Not T1 but T0. Prestige Limited has a KO of 15%. Right? It will raise funds through debt and equity in the ratio of 30 to 70. The company requires the cost of capital estimates for evaluating its acquisition, investment decisions, and the performance of its businesses. They are asking you to find out what the cost of capital should be, right? KBL's share price has grown from 150 to 301 in the last 5 years. Is it clear? Why is this given? To calculate
Great.
the growth rate. The company has recently paid a dividend of rupees 8. That means it is D naught. 8 rupees is D naught. For the calculation of equity, an average of 52 weeks, right, high market price in the last 5 years is to be considered, which is as follows. Okay, so average of this has to be considered for the purpose of calculating the average market price. So we are telling you equity share capital also has to be calculated using weights. So zero point 0.6 method, 0.6 weight has to be given to Gordon's growth model. 0.6, 0.4, weight has to be given for CAPM. Did you all understand? The risk-free rate is given. Then the long-term government, the market risk premium directly RM minus RF is given. Understood? Market risk premium is RM minus RF. Note it down there. 11% is nothing but RM minus RF. Its estimation of the beta is 0.78. You can find out KE using CAPM. So I told you you have to use this data to calculate the growth rate, right? Once the growth rate is found out, use the D naught was 8, therefore D1 is 15% of 8 plus 8. P naught is average of 52 weeks high price in last 5 years. That's what is given in the question. KE was found out using the formula D1 by P naught. Is it clear? Plus G obviously. Then KE using CAPM method. Put the weights and you'll find out what the weighted average KE is. Is it clear? The intrinsic value of debentures today they've given principal, interest, principal value, present value of 1 plus 2 and present value of 1 plus 2 at 15% and at 10%. Using interpolation, they found out what the cost of the debentures is. Is it clear? Yes, all of this you can do it. How much can be spent for the capital investment before new ordinary shares must be sold? If you remember this problem, what you have to consider is understand what the retained earnings is. Is it clear, all of you? Retained earnings is my equity portion. So divided by the equity percentage, you'll get the total investment value. Clear, all of you? Because you will, in this question, the sub question, the assumption is that the KO should be maintained as it is. For me to maintain the KO, the debt equity ratio should be maintained. Equity, normal addition to equity is retained earnings, which I cannot stop. Therefore, in order to ensure that the KO is consistent, constant, I should ensure that corresponding debt is also raised. Is it clear, all of you? Yes. So, therefore, the formula is very simple. Right? So when they ask you to calculate how much the capital investment before new ordinary shares must be sold, take retained earnings divided by the equity percentage or WE. Retained earnings by WE, you will get the total investment. From that, when you minus the value of debt, you will get the equity. All right. So what will be the marginal cost of capital? Cost of funds raised in excess of the amount calculated in part 3 if the company can sell new ordinary shares of rupees 22 per share, assuming both cost of debt and of preference share capital to be constant. So, all of you concentrate now. They want the cost of debt and preference share capital is also constant, right? So, therefore, look at this. This is the only thing that I want you to check actually. In this problem, what I want to show you, the rest of the problem you can do on your own. Yeah. The company can spend for capital investment before issuing new equity shares and without increasing its marginal cost of capital. Retained earnings can be available for capital investment. This is what I told you. You have to consider retained earnings first. Retained earnings, I think they have given is 50% of the earnings. They're 50% of 2023 EPS into equity shares outstanding. Right? You get retained earnings of 3,02,004 or 300 divided by equity percentage. Weight of debt, weight of equity is 80. Therefore, total value is 3,77,875. Right? So 3,02,300 will be debenture which they have given already, right? And preference shares, so that you minus the balance will be equity. Oh no. So 3,77,875 is the total investment. Idharali, retained earnings is 3,02,300. Clear, all of you? Total investment is 3,77,875. Everybody can see? Yes or no? And
Yes,
from
sir.
that 3,02,300 is what? 3,02,300 is my retained
Equity.
earnings. So there's nothing but retained earnings, correct or not? 50% of 2023 EPS into number of equity shares, retained earnings. The differential should be nothing but debentures and preference shares. Okay? So the current ratio of the debentures and preference shares. Now you have to calculate, okay, what should be the debentures, what should be the preference shares? Now, if the company spends more than 3,77,875 as calculated in part 3 above, it will have to issue new equity shares at rupees 22 per share. What is the Likita? How do I calculate the new KE now? So 50% of my retained earnings, the retained earnings I have to consider, right? 50% retained earnings, that is dividend divided by my current market price plus growth rate. D1 by P naught plus G will give me KE. If I'll please make a note. If the problem states, if the problem states if the problem states that the problem states that the equity shares slash preference shares, equity shares slash preference shares is some dividend, some dividend, immediately calculate the ex dividend price. Immediately calculate the ex dividend price for the purpose of computation of KE slash KP, for the purpose of computation of KE slash KP, for the purpose of computation of KE slash KP. Clear, all of you? Right? What do you mean by ex dividend and cum dividend? See, when there is a market price, when there is an equity share, dividend is announced first and then distributed. Clear, all of you? Dividend is announced first and then distributed. So, Ramya, they would have announced in March that you'll receive the dividend for financial year 24-25. Say, I'm just giving an example. Say, financial year 24-25 dividend is announced in the month of March. Clear, all of you? That you will receive it in the month of or on 1st of July. As soon as the dividend is announced, it's an information which is publicly available to all the shareholders. They know that they will receive this amount, so automatically the share price will capture this dividend value. Understood? So therefore, it is called cum dividend and ex dividend. If it is cum dividend, it includes this dividend value even though it is not distributed. Understood, all of you? So therefore, that is not the pure price of the share. That's not the pure price. You always want the pure price, so you have to exclude the dividend for the purpose of calculation of cost of capital. Understood? Right? Whether it is preference shares or equity shares. Right? Are related question number 15, I think, in your revision material. Page number 201. Is it correct? Page 201. Yes. Page 201, everybody. Okay. Mark that and then solve that problem. You'll get ex dividend and cum dividend price question. Clear?
Yes, sir.
All right. So one more problem. Yeah, just look at this. The cap structure of Shine Limited. This is your Jan 26 RTP. Okay. The cap structure of Shine Limited as on 31st March 24 is as under. Right. Equity share, preference shares, retained earnings, convertible debentures, and term loan is given. The company has issued 13% convertible debentures of rupees 100 each on 1st April 23 with a maturity period of 6 years. Is it clear, all of you? Therefore, 1st April 23, Andre, is this present or past? It is past. Is it clear? Because we are today as on 31st March 24. At maturity, the debenture holders will have an option to convert the debentures into equity shares of the company in the ratio of 1:4, that is 4 shares for each debenture. Clear, all of you? The market price of the equity share is rupees 25 each as on 31st March 24, and the growth rate of the share is 6% per annum. Therefore, the maturity period is, look at this now, all of you be careful now. The maturity period is how much for the convertible debenture?
6 years.
6 years. 6 years. Therefore, I should do into 1 plus g to the power what? Into 1 plus g to the power what should I do? To calculate what is the growth rate? Tell me. Or to find out, sorry, to calculate what my share price is. Yes, share price I need at the end of 6th year, all of you. Share price I need at the end of 6th year. Everybody with me? Correct? Therefore, I should do into 1 plus g to the power what? To get my share price as on the end of the 6th year. Tell me quickly. Not current year share price is how much? Current year share price is how much? Quickly. Look at the question. Current year share price is how much? The market price of the equity share is rupees 25 each as on 31st March 24. Is it clear, all of you? So now it is 25. I need the share price at the end of 26. So therefore, into 1 plus g to the power 25 into 1 plus g to the power. What, Baba? Quickly tell me.
5.
5 or 6?
6.
6 or 5? Quick.
5.
5.
5. Be very careful. Why? That is why. But why? I don't know why you're taking so long. It's okay. Mistake is a mistake or correct answer. But you cannot take so long to answer. Right? Somewhere you knew that there is some catch here. That's why I was asking so many times. And that's why you're thinking. You have to answer quickly. Right? Whether correct answer or wrong answer. But you have to answer quickly. Only then you know whether you're making a mistake. In examination, no time to think. Immediately it should strike. Why? Because look at this now. The company issued when, all of you? On 1st April 23. Is it clear? Therefore, already how much time has passed? Already how much time has passed? Quickly.
1 year. 1 year.
1 year
1
has
year.
passed. Therefore, balance life is how much?
5
years.
5 years. Understood, all of you? Yes. Then preference stock redeemable after 8 years at par is currently trading at 150 per share. The prevailing default risk free interest rate of 10-year government, GOI bonds is 6%, RF is 6%, average market risk premium RM minus RF is 8%, and beta is 1.54 using CAPM calculate KE. Is it clear? You're required to calculate the cost of equity share capital, preferential capital, convertible debentures, retained earnings, and term loan. Very simple question. Extremely simple question. Easy question. Yes. So CPM KE, easy. Next, cost of preferential capital, convertible debentures. Look at this 5. Mark this important. Right? This 25 into 1.6 to the power 5 is important. This is where many of you would have gone wrong. That's it. Okay. This is your cost of capital. All right. So the next chapter, that is capital structure. Sit straight off. Capital structure is the combination of capital. How much should be debt? How much should be equity? Right? What proportion? Should I go with 10% of debt, 90% equity, 90% equity, 10% debt? Should I go with 50%, 50% debt, and 50% equity? All this is answered in your chapter capital structure. This also helps in your financing decision. Correct? What is your financing decision? Right? I told you what is the source of finance, and more importantly, what should be the quantum and what should be the proportion of the source of finance. Yes or no? Therefore, all of this we understand by in the chapter capital structure. What is my optimum capital structure? It is that combination of the capital structure wherein my overall cost of capital is the least. It is that combination of capital structure where the overall cost of capital is the least, that is KO is least. Is it clear, all of you? We all know VF, value of a firm, is nothing but EBIT by KO. EBIT by KO. Why EBIT? Earnings before interest and tax, right? Because that is the return that is available for all the providers of capital, including debt. Therefore, it has to be before interest. Is it clear, all of you? Therefore, EBIT by KO is equals to Nityasri is equals to VF. Here, T. Normally, tax rates are not considered, right? In most of the theories, the tax rate is not there. Therefore, it is just EBIT by KO. Otherwise, you can also take NOPAT by KO. That is EBIT into 1 minus T by KO if there is tax. Is it clear?
Yes, sir.
Right. So why EBIT? You need to consider both. Now, for example, let's go one by one. For equity shares, the formula is NI by S, net income by, sorry, for equity shares, the value of equity, VE is equals to NI by KE. Is it clear? NI by KE is equals to VE. Right? NI by S is KE. NI by S is KE. Is it clear, all of you? Yes.
Yes, sir.
And value of debt is nothing but interest by interest percentage, right? KD, or V minus S, where S is value of equity. Is it clear? Yes. So these now VF is equals to EBIT by KO. Therefore, lower the KO, higher is the value of the firm, and always our objective is wealth maximization. Right? Therefore, it is that source of capital where KO is the least. Now, we all know the formula KO is equals to WD into KD plus WE into KE. Again, in your entire chapter, we are only considering about long-term source of finance, and that too only two sources of finance, debt and equity. Is it clear? Right? Now, when you take debt and equity, VF is equals to EBIT by KO. Lower the KO, higher is the value of the firm. Lower the KO, higher is the value of the firm. Yes or no? Now,
Yes,
for the
sir.
KO to be less, right? There are different approaches. There are different approaches that have different, you know, point of views. First one is your relevance approach. That is relevance theories. These theories states that, right, capital structure decisions are relevant. Is it clear? These theories state what? That the capital structure decisions are relevant. Irrelevance theories, what do they state? That the capital structure decisions are irrelevant. Right? That means you are no god, boss. Your decisions don't matter. Right? Whatever decision you take, the value of the company would be same. Is it clear, all of you? Right? Yes. So again, the approaches that consider that capital structure decisions are relevant, in that there are minute subtle differences because of which, right, the assumptions they take, it has the value, and that is what creates an impact on the value. And those subtle differences are the distinctions between relevance and irrelevance theories. First one is your net income approach. And the net income approach, the assumption is that with increase in the weight of debt, KD and KE remaining constant, Likita, KO should decrease or increase. What do you think? With increase in the weight of debt, KD and KE remaining constant, KO should increase or decrease?
Decrease.
It should
Decrease.
decrease because KD is always less than KE. Because of two reasons. One is because of tax advantage of debt. Second is because of, why is KD less than KE? Because in risk is lesser than KE, equity shares. Because risk is lesser, there and then there is tax advantage on debt. Because of both the reasons put together, KD is normally less than KE. Is it clear? And therefore, if KD and KE are constant, and if the weight of debt is increasing, and the assumption is that the increase in the weight of debt is substituted with the decrease in the weight of equity, because the source of capital, the total capital requirement doesn't change. The total capital requirement doesn't change. Is it clear? Therefore, net income approach suggests that more the value of debt, more is your lesser is the cost of equity, overall cost of capital. Clear, all of you?
Yes.
Next comes your net income and then your net operating income approach. Under net operating income approach, the assumption is that with the increase in the weight of debt, KD will remain constant. However, KE will start increasing because the equity shareholders start perceiving higher risk. I repeat, with the increase in the weight of debt, KD will remain constant. However, equity shareholders start perceiving higher risk, because of which KE starts increasing. Is it clear, all of you? The increase in the weight of debt should have resulted in the decrease in KO, correct? The increase in the weight of debt should have resulted in the decrease in KO. However, it is compensated by the increase in KE. Therefore, while the form remains constant. Therefore, VF is constant, KD is constant. WD increases, WE decreases, KE is keeps increasing. KE keeps increasing, KE is not constant. Understood, all of you? Therefore, under net operating income approach, the capital structure decisions are irrelevant, because irrespective of the debt equity ratio, the Q will remain constant. Clear? Yes. That is your NOI approach. Then comes traditional approach. Under traditional approach, up to a certain level, debt is good. Up to a certain level, debt is good. The value of the KO keeps decreasing up to a certain level, and the value of the firm keeps increasing. However, beyond a certain level, KD increases and KE increases, and therefore even KO starts increasing. The value of the firm starts coming down. Is it clear? Therefore, at that point where KO is the least and value of the firm is highest, that is called optimum capital structure. Is it clear?
Yes, sir.
That is my traditional approach. Traditional approach, right? There is a combination of net income and NOI. Yes, that is with the increase in the weight of debt beyond a certain level, KD will increase, KE will increase, and therefore KO also will increase. However, up to a certain level, KO will decrease. KO will decrease. Therefore, you find out what that optimum capital structure is. Is it clear? Yes. So that is N your net income approach, NOI approach, and traditional approach. Clear, all of you? These three methods, these three theories. All right. Next, we learn MM model with tax. Sorry, MM model without tax, 1958. What is MM model without tax? It is same NOI approach. It is same NOI approach. However, they've justified it through arbitrage mechanism. Arbitrage is that two commodities that belong to the same risk class, Two commodities that belong to the same risk class should have identical price in any market. Is it clear, all of you? If the prices are not identical, if it is not same, then there is a chance of arbitrage gain or loss, as the case may be. Then there is scope of arbitrage gain. Is it clear, all of you? Right. So what will people do? They will buy the stock which is underpriced, and they will sell the stock which is overpriced. Is it clear? Right. And in this process, they will enjoy and they will make arbitrage gains. Clear, all of you? Right. So under model without tax, obviously the same formulas that you've learned earlier will apply. Right. That is, what are the formulas we learned? Your value of the firm, how do you calculate? Yes, value of the firm is equals to your value of debt plus value of equity. VF is also equal to EBIT by KO. All of that will still apply here also. Clear, all of you? Under, because I told you your Modi, Clan and Miller is nothing but your NOI approach. However, there are certain additional points which I've discussed now. Is this clear? Yes? Alright. Now, your common assumptions for all of these four approaches. One is there is no tax. Then capital markets are perfect. There is no transaction cost. Are you able to remember all of this? Then the total capital requirement doesn't change, right? Equity, the increase in equity will be substituted by the increase in debt. Clear, all of you? Yes. So they are some of the common assumptions. However, some assumptions specific to model with without tax. Model without tax. Some common assumption is that personal leverage is corporate leverage is substitutable with personal leverage. Corporate leverage is substitutable with personal leverage. Is it clear, all of you? Yes. Next. So yeah, it is a combination of capital from different sources of finance. The capital structure refers to the combination of debt and equity which a company uses to finance its long-term operations. Again, right? It is long-term in nature. Next, optimum capital structure. It is that capital structure where value is maximum, right? Refers to that mix of debt and equity at which KO is minimum. Since lower KO, higher the value of the firm. An optimum capital structure is a financial plan having an appropriate debt equity mix which minimizes the overall weighted average cost of capital and maximizes the market price of the share, thereby maximizing shareholders' wealth. Theories: relevance, irrelevance, and others. Under relevance theory, you have net income, traditional approach, model with tax, and under irrelevance, you have net operating income, model without tax, and then others, you are picking theory and trade-off theory. 1, 2, 3, and 4, no tax assumption. Fifthly, there is tax, obviously, model with tax. Then there are only two sources of capital, debt and equity. Total capital employed remains constant. Increase in equity will be used to redeem debts and vice versa. EBIT remains constant, very important, right? So your both, it should belong to same risk class as well as should have the same income. There are no corporate taxes or transaction cost, no growth. Therefore, A by I formula can be used. There are no retained earnings. Entire profits are paid as dividend. Therefore, DPR, dividend payout ratio, is equal to 100%. Right? There is perpetual life and then business risk is constant. These are the formulas which you already discussed. Right? Net income approach, I told you, with the increase in the weight of debt, KD remaining constant, KE remaining constant, KO should come down. NOI approach, right? Already discussed. In that, your KD remains constant. With the increase in the weight of debt, KE starts increasing because they perceive higher risk. However, KO also remains constant. Traditional approach, up to a certain level, debt and equity both is good. It keeps coming down, but beyond a certain level, debt is not good, and therefore equity, right? Debt is not good, and therefore KO starts increasing. KO starts increasing. Clear? Model without tax, 1958. Arbitrage process is the process by which similar products having different prices in different markets at the same time are brought to equilibrium. Therefore, buy at underpriced, right, or lower price in one market and sell at higher price in another market, that will lead to riskless profit. Right? CS decisions are irrelevant as per model without tax. When you're moving from a levered company to unlevered company, or if you concentrate now, then you sell 10% of the equity, And then since you're moving from a levered company has debt that is substituted with personal debt, you take 10% of what? 10% of the overall debt clear of the company, other to 10% you will borrow from the market. Is it clear all of you? Therefore 10% equity is sold, 10% of the personal debt, right? 10% of the total debt of the company is taken as a personal debt from the market. Then this entire value is invested, sorry, the quantum of value will depend on the two approaches. This is invested in an unlevered form. Now if you're going for increase in income approach, entire amount is invested. If you're going for savings and investment approach, then probably in the earlier step you could have considered only 10% investment. Is it clear? Right? Invest only 10% of the entire proceeds in the company. Again in both. If it is an unlevered form, then obviously only in equity. Now, unlevered to levered, again assume 10% equity is sold. Is it clear, all of you? Then invest in a levered form, increase in income approach and savings and investment approach. Here again, invest the entire amount in savings and investment approach. Invest 10% in the total value of debt plus equity. Mark this important. Right? Total value of debt plus equity. Model with tax, he says that two firms, if there is no debt, the value is same as long as the risk is same and income is same. Clear all of you? However, right? Model with tax, he says, yes, the value of the two firms should be same. However, with tax means levered firm should have the tax advantage on debt. Should have the tax advantage on debt. Is it clear all of you? Therefore, VL is equals to VU plus DT, where D is the value of debt, T is my tax rate. Clear? Yes. Next. Right? VL is equal to VU plus DT. When a levered firm is asked to be valued using model with tax, then follow the below steps. Right? VU is equals to EBIT into 1 minus to be a KU star. KO star or KEU. That is cost of equity of a unlevered firm. Is it clear? Cost of equity of an unlevered firm will be equal to the cost of overall cost of capital, yes or no? Correct? The cost of an unlevered firm, right, is nothing but KO. Can I say KEU is equals to KO? Everybody agrees or not?
Yes.
Yes, sir.
Yes, it is nothing but KO. Yes. So assume that the firm is unlevered, then tax advantage on that DT, VL is equals to VU plus DT, right? KO is equal to of the levered firm is EBIT into 1 minus T, that is no pat by VL. KE is pat by S. Taking out a theory, why does it happen? Because of information asymmetry. I told you not everybody has access to all the information. If you use retained earnings, it sends no signal. If you use debt, it sends positive signal because it shows confidence. If you send external equity, if you raise through external equity, then it sends a negative signal. Trade off theory, right? This is same like your model with tax. However, it also considers the cost of financial distress. This theory says that okay, you're considering the benefit as a tax advantage, but there is also a cost associated with that benefit that has to be considered. Therefore, subtract cost of financial distress. Is it clear? Yes. Right. So VL is equals to VU plus DT minus cost of financial distress. ROI ROE relationship extremely important from examination perspective. Market important, right? ROE is equals to ROI plus ROI minus I into D by E into 1 minus T. If you don't remember this also, at least the KD formula, KO formula you should remember. KE is equals to KO plus, right? KO minus KD into D by E into 1 minus T. Is it clear? Yes. EBIT EPS relationship. MPS is equals to P into EPS. Financial break-even point. Please correct it. It is interest, not whole divided by interest plus PD divided by 1 minus T. It is that level of EBIT at which EPS equal to 0. That is my financial break-even point. Indifference point. It is that point or it is that level of EBIT and of at which, right, It does not matter whether we go for higher debt, higher equity, etc. It's an indifference point. So EBIT star minus interest 1 into 1 minus T by number of shares or equity shares of first alternative. EBIT star minus interest of the second alternative, right, into 1 minus T by number of shares of the second alternative. Equate it and solve for EBIT, that is my indifference point. Overcapitalization is a situation where the firm has more capital than it needs. Right? So if you remember asset turnover ratio, where the asset turnover ratio is less, it is a symbol of, or it indicates overcapitalization. Undercapitalization is, it is just the reverse of overcapitalization. Actual capitalization is lower than the proper capitalization as warranted by its earning capacity. Okay, let's go through some problems now. Leverages, leverage, sorry, cost, capital structure first. Capital structure page number 211. Yes. So, Namra Limited provides you with the following information: operating profit, debentures, earnings before tax, PAT, preference dividend, equity shares, number of equity shares, and EPS. The reserves and surplus of the company is at rupees 9 lakh, and Namra Limited requires additional funds of rupees 15 lakh. Additional funds means what? Additional funds means which? What is this? This is my additional requirement only. That is my marginal capital. Clear, all of you? For modernization and expansion, the current capitalization rate of the equity is K. Therefore, K is equal to 20%, and company has a policy to retain 40% of its earnings. Therefore, retained earnings is 40%. Debentures and preference shares are trading at a premium of rupees of 10% and 20%, 25% each to its current book value respectively. The fair value of the equity shares is calculated by dividing the number of equity shares to the overall value of the firm. Okay. New equity shares for expansion will be issued at 15% discount to the current market price or to current fair value. The return on capital employed, which is based on the total value of the firm, will increase by 10% to its current rate after expansion and modernization. If the capital gearing ratio goes above 2.5, then interest rate on additional debt will increase by 200 basis points, and dividend on preference shares would increase by half percentage. You're advised on the below. You're required to advise on the below two financial plan to be selected based on earnings. Two-third amount is raised through debenture and remaining by preference shares. Issue of equity shares only. These are the two alternatives. Have we solved a similar problem like this or not? All of you. Yes? Correct or not? Haven't we solved a problem like this? Wherein different sources of, right? Your finances, etc. is given. Now look at this. Here, income statement is given. Clear, all of you? Your income statement. The reserve and surplus of the company is at rupees 9 lakh. Then it requires additional funds of 15 lakh. They're given for modernization and expansion. Then equity capitalization rate is given. Right? The debentures and preference shares are trading at premium of 10% and 25% is given. 15% discount to the current, fair value price will be the new equity share for expansion. All right. The required advice on the below. Two financial plan to be selected based on earnings. Very simple. Draw the two columns, right? For first, in case of financial alternatives, I always calculate what? I calculate the additional EBIT on the additional income. Clear, all of you? Right? Additional EBIT. Second, we calculate the interest amount, not rate, amount. And third is your number of shares. In some cases, interest rate is also recomputed because they are given that if the debt equity ratio goes beyond 5, then the interest rate will increase to 14%. Please be very careful when they use the word to or by. Understood, all of you? Right? That is what has to be considered. Now, so working on number 1, calculation of EBIT after expansion. They have not given the ROC, therefore return on capital employed. is based on the total value of the firm. So first step would be to calculate the total value of the firm. Total value is value of debt plus value of preference shares plus value of equity share plus value of reserve and surplus. Did you all understand? There is nothing but capital employed. Clear, all of you? Yes.
Yes, sir.
VD is equal to interest by interest percentage plus 10% premium. Preference shares is preference by preference dividend percentage into 25 plus 25% premium. Value of equity dividend by KE. Value of reserve and surplus 9 lakh. Therefore, value of the firm, add everything, you get the value of the firm. ROCE before expansion, EBIT by value of the firm, you get 16.58%. After expansion, they're saying it will come to 18.24%. Yes. Capital gearing ratio means fixed percentage bearing funds. All of you concentrate. Capital gearing ratio is fixed percentage bearing funds. What are the fixed percentage bearing funds? Your debt, that is your debentures, bonds, even preference shares. That's the difference. Understood? Even preference shares has to be considered for what? Your capital gearing ratio formula. Is it clear? Yes.
Yes, sir.
All right. Calculation of additional number of equity shares when funds are raised through equity, all that is given here that you have to come and do. And then prepare your investment statement, income statement. Now, all of you concentrate. Income statement, only the decision should be based on EPS or MPS. Which financial alternative is better? You will decide based on EPS or MPS quickly.
MPS.
Always MPS because of wealth maximization objective. But if P is not given, then you need to stop as EPS and then assume based on the presumption, not even assumption, presumption that the P is constant. You will choose that alternative that has higher EPS. Is it clear? Yes,
Yes.
that is my two financial alternative problems. Yes, look at this from all of you. Kashyap, are you there? ER Private Limited has a paid up capital of 2,50,000 consisting of, yes, 25,000 equity shares of rupees 10 each. The market price per share is 24 and the P ratio of 8. The following is planning to purchase a plant which will cost rupees 5 lakh. Clear? The company is planning to purchase. This plant is expected to yield earnings before interest and taxes of 2 lakh per month. It has two as the plant, right? Equity and debt is given. Cost of equity and all of that is given. So if you see in capital structure, what is more frequently asked? Your financial alternative problem. Are you able to observe that? All of you? Yes. There's also another financial alternative problem. But look at this, very important. The price earning ratio is given. You need to multiply that and you have to consider MPS before giving the decision. Again, another financial alternative problem. I hope you are able to see all this. Now look at this. This is MM model. Now the following data is related to two companies belonging to the same risk class. Very important this is, because otherwise your MM model we cannot apply. Next, expected net operating income, 12% debt and equity capitalization rate is given. 18 lakh by 18% will give you what? What is 18 lakh by 18%? Anybody quickly?
Value of fund.
Value of the firm. Why? Because in KEU, 18% itself is equal to KO. Therefore, EBIT by KO will give you value of the firm. Is it clear? Right? So that is 18%. Next, determine the total market value, equity capitalization rate, and weighted average cost of capital for each company, assuming no taxes as per MM model. Right? As per MM model, let us assume no tax and then do it. Clear? Next, expected net operating income is given. Or if you concentrate now, that is 18 lakh. Correct, everybody? Now, 12% debt, 54 lakh. Therefore, 54 lakh into 12% is how much?
6,40,000.
Yes, 6 lakh
48,000.
48,000.
6 lakh 48,000 is my interest. Therefore, 18 lakh minus 6 lakh 48,000. 11 lakh 32,000, correct?
52,000.
Ah, yes. 11 lakh 52,000. Clear, all of you? That is your value of what? Value of what is
No
11 lakh
bad.
52?
No bad.
Right? No pat. Is it clear? That is my no pat. Now, you have found out the no pat. Value of the firm, if it is both with, whether there is debt or no debt, what will be? Will it be same?
Yes, sir.
Value of the
Yes.
firm will be same. So therefore, if it is 100 lakh for B limited, it will be 100 lakh for A limited also. 100 lakh minus 54 lakh is what? 100 lakh minus 54 lakh is what? Quickly tell me.
Equity.
Right? So that is my equity. And 18 lakh net operating income minus interest will give you your net income. Net income by equity will give you what? NM by S equal to
KE.
KE. Using that approach only, the entire problem is solved. Clear, all of you? Go through this computation of weighted average cost of capital after considering the weights. ಅರ್ಥ ಆಗ್ತದೆ ನಿಮಗೆ? Yes, based on what is given and what you calculate, using that they have calculated what the weighted average cost of capital will look like. Next, levered company, unlevered company, all of you concentrate now. Debt is given, equity is given. The following data is available with respect to levered and unlevered companies. Having same business risk class, that means MM model is applicable. Capital employed is 2 lakh, EBIT 25,000, KE is 12.5%, and investor is holding 12% shares in levered company. Clear, all of you? The increase in the annual earnings of the investor if he switches. So what is increase in annual earnings? Which approach is this? Which approach is this?
Interest and investment.
Yes, increase in the annual earnings, increase in income approach. Right? If he switches over his holding from levered to unlevered company, the same thing you have to do and show that it actually should not have an impact. But however, arbitrage gain will be possible if it is not valued properly. Right? So EBIT less interest, earnings available to equity shareholders, then KE, then you get value of equity. Yes, debt is nothing but subtraction, the balancing figure. Hmm. So arbitrage process, please follow the step-by-step approach what I have discussed in the class. Is it clear? Yes?
Yes.
All right. Look at this problem. J Limited is an all equity financed company with a market value of 25 lakh and cost of equity of 21%. Right? So market value is given and then cost of equity is given. What you can find out? From that quickly it should strike, all of this should strike. I'm not even reading the process, question further. What I'm saying is, as soon as you read this, what do you come from it? What do you have to immediately get figures in your mind. Now it's an all equity finance company, that means there's no debt. Therefore can I say ke is equals to keu or ko? In this case ke is equals to ko. Next,
Yes.
market value 25 lakh is given, ke 21% is given. What you can find out? Market value is given, ke is given. What I can find out?
EBIT.
EBIT base, no pat I can find out, yes or no? No pat, immediately it should strike. Clear? The company wants to buy back the equity shares worth rupees 5 lakh. Yes. By issuing and raising a 15% perpetual debt of the same amount. Rate of tax may be taken as 30% after the capital restructuring and applying MM model with taxes. MM model, what is this? With taxes, you are required to calculate market value of J Limited cost of equity, and weighted average cost of capital. Now, market value of J Limited. After that, that is nothing but VL is equals to VU plus DT. Is it clear, all of you? VU is 25 lakh they have given. Plus debt is how much?
5 lakh.
5 lakh into tax rate. Is it clear? That is my market value of J Limited. Next, cost of equity after the, for when there is taxes, what is KE? You need to recompute this, yes or no? How will you recompute? Again, find out what the net income is and divide it by my value of the firm, or using the other formula. What is the other formula? KE is equals to KO plus within bracket KO minus KD into D by
D by
S
S.
the whole into 1 minus T. Is it clear? Into D by S the whole into 1 minus T. Using that formula also you can find out what the KE is. Next, weighted average cost of capital using market value, weights and comment on it. Simple problem. Yes. All right. So we're left with your dividend decisions, leverages and dividend decisions both. Okay. Before I do that, I think we'll just go through the entire suggested answer. Come down, all of you. Yes. So if you see here, there are two parts. One is your MCQs and your descriptive question. Part 1 will be for 30 marks. In that, normally there will be one case scenario question for 10 marks, and then your three independent questions, 2 plus 2 plus 1. If you want, you can write down marks pattern. In that, 2 arrow marks. Left hand side, part 1, MCQs, other really, 2 arrow marks again. Left hand side, normally 10 plus open bracket, 2 plus 2 plus 1 close bracket. 10 plus open bracket, 2 plus 2 plus 1 close bracket. Ali 10 kilgade, case scenario 1. Under 2 plus 2 plus 1, you can write independent questions. Is it clear? Part 1, ಮೇಲ್ಗಡೆ ಬರೀರಿ 15 marks. Next, second arrow mark under part 1, rarely 1 plus 4 plus 1, 10 plus 4 plus 1. 10 ಗೆ case scenario 1, 4 ಗೆ case scenario 2, 1 ಗೆ independent question. ಏನಾದ್ರು ಅರ್ಥ ಆಯ್ತಾ? Next, right hand side, descriptive. Part 2, descriptive, 70 marks. Part 2, descriptive, 70 marks. Sorry, 70 ಅಂದ್ರೆ ಇದು ಇದಲ್ವಾ, 35 marks. 35 marks, sorry. Part 2 descriptive, 35 marks. Part 2 descriptive, 35 marks. Okay. In that, question 1 compulsory. Then any two of the remaining three. ಇಲ್ಲಿ draw 3 arrow marks. Under that, under first arrow mark, write down question 1. Under first arrow mark, write down question 1. Compulsory. It is normally 5 plus 5 plus 4. 5 plus 5 plus 5. 5 plus 5 plus 5. Clear, all of you? Next. Second arrow mark, Draw two arrow marks. Draw two arrow marks. Under that, first arrow mark, question 2. Question 2. Second arrow mark, question 3. The flower bracket and write 7 plus 3 or 7 plus 3 or 8 plus 2 or 8 plus 2 or 6 plus 4 or 6 plus 4 and rarely 5 plus 5. Rare. I have not seen 5 plus 5. Clear? So it could be normally 7 plus 3. It could be 8 plus 2. Normally capital budgeting questions are 8 plus 2 barutte. Right? Or 7 plus 3, 8 plus 2, 5 plus 5 is rare. Understood? So total 10 marks each question. 10 marks each question, question 2 and 3. Last one, question 4. Theory, descriptive theory, normally theory, normally theory, normally theory. 4 plus 4 plus within bracket 4 plus 4 plus open bracket 2 or 2 close bracket 4 plus 4 open bracket 4 plus 4 plus open bracket 2 or 2y. You'll get a choice either this or that 2 marks on theory question, right? Next question 1 compulsory, therefore irrelevant for decision making. You have to do that. Question 1. Question 4 strongly recommended, strongly recommended, strongly recommended. Easy repetitive theory questions asked, easy repetitive theory questions asked. Normally 4 marks from question of chapter 1 and 4 marks from chapter 2. Normally 4 marks from chapter 1 and 4 marks from chapter 2. Okay. 8 marks normally ಅದರಿಂದನೇ ಬರುತ್ತೆ. ಕೆಲವು ಸತಿ yes, sometimes they might skip either chapter 1 and chapter 4, but I've not seen them skip chapter 1. Chapter 1 ಏನೊಂದು ಕ್ವಶನ್ normally comes. ಅರ್ಥ ಆಗ್ತಿದೆ ನಿಮಗೆ? ಸೊ ಚಾಪ್ಟರ್ 1 ಚಾಪ್ಟರ್ 2 ನಾರ್ಮಲಿ ಎಲ್ಲ ಕ್ವಶನ್ ಇದ್ದೇ ಇರುತ್ತೆ. ಅದ್ರಲ್ಲಿ 4 marks and 4 marks. ಆ ಎರಡೇ ಚಾಪ್ಟರ್ ಇರೋದು which I will anyway comprehensively cover. Right? Why do you want to miss anything of these 2 chapters? You can score 8 marks from this. Is it clear? Obviously, from others also you can come. For example, capital structurally, if you remember, I told you overcapitalization, undercapitalization theory I had covered. Any of their capital structure theories can come. Dividend decisions theories can come. Your investment decisions, one of the capital budgeting techniques can come. Right? So your conceptually practical theory question, you will be able to answer because you have already learned the concepts. ಅರ್ಥ ಆಗ್ತಾ ಇದೆ ನಿಮಗೆ? Yes. Otherwise, these 2 core theory chapters are there. That also you can score. So highly recommended. It saves time, no? To save time. Write down to save time. You can save time. So question 2 and 3 get put a downward arrow mark and write down any one. Any one. So in FM, if you're again, sir, na theory prepare madilla andre, then obviously you have to see and then decide whether you can write or not. Your knowledge is not there, then sumne aman sir ಬರ್ದಿರ ಅಂತ ಬರ್ಕೊಂಡು 2 out of 10 if you score, I can't help. But otherwise, if your preparation is pakka, you know, sir, yes, I can score 8 out of 10, 9 on 10, 10 on 10 easily in theory. Then you're decided, you know that theory you will do. Clear? Then question 1 you don't have a choice, you need to do. Then your elimination is only question 2 or 3. So when you get that question paper, you know exactly what should you be your focus in the first 15 minutes to choose either you're writing question 2 or question 3. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ?
Yes, sir.
Either question 2 or question 3. See, I've narrowed down the whole thing. Right? Either question 2 question, pick that, you choose which one is rejection question for you. Ali mugitu. Your most important decision is done. The first 15 minutes. Understood? Then you know we will give you the preferred selection. So first we normally suggest write the descriptive of your FM, then come to the MCQs because you've got SM also. Then go to MCQs of SM and then go to the descriptive of SM. Atara, it is structured. You will know what our suggestion is, the flow of the question paper. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? Because our MCQs you cannot miss. So that is in the center of FM as well as because sometimes case scenarios will be, it needs time to read the case scenario, understand it. Sometimes lengthy irutte. At the starting ಅಲ್ಲಿ definitely do not see any case scenario. Do not see any case scenario in the starting for almost all papers. That is my strong recommendation. Do not see MCQs. Sometimes the case scenarios will be tricky, or it is not tricky also, it is perceived to be tricky because of the length, right? And if it's a new case study you have not read before, it will take some time for you to read it, comprehend, and understand. Clear, all of you? Yes, even in SM, they can give you sometimes some tricky MCQs, right? So be careful. That is why in the center, don't start with your MCQs. Is it clear, all of you? Yes. All right. It's an easy scoring paper. Definitely you can do well. Remove any apprehension, aversion you have towards the subject. Okay. Prepare well. And most important, do not focus only on FM. SM is also equally important. You need to give equal importance to SM. What is off late people are doing? They're only reading FM. SM, they're not scoring, which is very bad. SM is an easy, high scoring subject. Problem is you're not giving the due respect the subject requires. Please give the respect the subject requires. You can easily score well. You can easily score well, and put together combined. Only then, if your preparation is equally good in both subjects, only then you'll be able to score, 75, 80, 85, 90, whatever in this paper. Okay. Just studying on FM, no good. SM alone, no good. Both you have to equally give importance and prepare. Okay. Yes. So, anybody, any questions you have, you can ask me. Otherwise, I think I will conclude today's session, and then because I'm left mainly with leverages and dividend decisions, which I'll be covering in the next class. All right. Next, this thing, revision session, I'll do that. Oh. All right. Anything else? That's all. Okay. Thank you, everybody. Bye, all of you. Have a great day.
Thank you.
Thank you
Thank
so
you,
much,
sir.
sir. Bye, sir.